but knowing that, because obviously this is not a secret, if you are in academia and in university, that we have this bias. It's not only that, there are also many other different biases. Okay, so if you obviously are not from a top school or top university, it's also very tricky to get your study, even though if it's conducted very, very well, into one of these top journals, because they tend to publish only their own papers or the papers from their let's say buddies. So that's another big problem. But first of all, let's talk about this publication problem that we have. That these editors just tend to publish rather positive than negative results. And knowing that, what some scholars unfortunately have been doing is something what's called p-hacking. So that's of course not okay, but it's of course also on the other hand difficult to prove, at first glance. So p-hacking means, for instance, if you slightly change your methodology, or basically you have a pool, let's say you have a pool of methods to choose from, and if you want to get your paper into a good journal, what some people or what some scholars are doing is they choose a certain method that shows a positive result, or they change the sample slightly, or they somehow adjust their methodology in such a way that they somehow get a positive result, in order, of course, to get the paper published, in order to make a career or in order to make progress in their job. So obviously these two problems here are somehow related. So because if editors would not tend to focus on publishing only positive results, if they would also publish in the same manner negative results, people would be less prone for p-hacking. So these two issues obviously they are related. And the final issue is like smart beta investing. You might have heard about smart beta funds. Okay, smart beta funds. So what do they do? So these smart beta funds, obviously, these are investment funds or mutual funds that somehow aim at exploiting certain patterns in stock returns that have been documented in the literature. So for instance, knowing that small stocks outperform big stocks, or that stocks that have a high profitability outperform stocks that have a weak profitability, or that stocks that have a low investment growth outperform stocks that have a high investment growth. So what you can do is you can invest in stocks that are small, that have a high profitability, that have a low asset growth, and that belong to the past winner category. So they try to exploit these cross-sectional patterns in stock returns. But the problem arises, obviously, if these strategies that have been shown to be to deliver or to generate a certain payoff, if these strategies are just sample specific, if they actually doesn't exist, if it's just a white noise. So if people are fooled by randomness, okay, then obviously that's a problem, because it would imply that these strategies actually doesn't work out, and your expected payoff is not the same out of the in-sample expected payoff is, or the average payoff in-sample has no explanatory power for the future performance of your investment strategy. So that's why it's important to scientifically replicate published studies. So how do they proceed? Let's take this away. So first of all, they use the whole universe of anomalies, and we already spoke that we have 452 anomalies, and they divide these 452 anomalies into 6 subgroups. Yeah? So in the first subgroup we have the anomalies that are referred to momentum. Yeah, and obviously there are many different strategies, yeah, that are related to this type of anomaly, and we'll come back to that soon. So the second category of anomalies, they call it value versus growth. The third group of anomalies, they call it investment anomalies. Investment. Then the fourth group, it's called, or it's anomalies related to profitability. Profitability. So, and if you now remember what we discussed last time, when we discussed about the paper choosing factors, so Palmer and French, they were testing if cash profitability or operating profitability, which to choose, which performs better or which has more explanatory power. So obviously there are different measures how you can measure the profitability of a firm. Yeah? The same is for investment, and the same is true for growth and all the other groups. Yeah? There are different ways how to measure each characteristic. Yeah? So the fifth group, they call it intangibles. Intangibles, and the last group is referred to trading frictions. Yeah? Trading frictions. So, and of course, in each of these groups are a different number of anomalies, which we will see when we go through that paper. So, as we already told, so they use decile sorts for each of these 452 anomalies, and they use 2 different statistical procedures basically. We remember from econometrics or from statistics class, we have this normal distribution. Yeah. And we have the critical values of 1.96 here. And here on the other hand we have the critical value of minus 1.96. Yeah? So whenever the sample average of an anomaly is above 1.96, we would say, okay, the payoff of this anomaly is significant on a 5% level, because we know that 95% of the probability, if we have a normal distribution, is in between these values of minus 1.96 and 1.96. Yeah? So we would reject the null hypothesis that the payoff is 0 on a 5% level. Yeah? But there's a problem, obviously, because, and they call it multiple testing, the multiple testing problem. So the thing is, because of this, it's also basically related to p-hacking. Yeah? So if you try multiple strategies, and then you take only those or this strategy that turns out to be significant, but you have done many tests already beforehand. So that's why they argue, or there's a paper published basically that argues for that we should take a higher hurdle than 1.96 because of this multiple testing problem. So the multiple testing hurdle, or the t-statistic, the corresponding critical value of the distribution, is not 1.96 then, but it becomes, it's somewhere here, it should be 2.78. Yeah. So using this higher hurdle, yeah, should ensure that the result is more robust. I mean, obviously it makes sense. The higher the t-statistic, the more robust or the more significant is the average, the sample average. Yeah? So they use two different t-statistic or two different critical values. One is the standard value of 1.96 that we have in most papers, that we see in most published papers, and this new multiple testing hurdle of 2.78. Yeah? What else do they use? Yeah, they use obviously the CRISP database. So the Center for Research and Security Prices. It's a US database where you get basically the prices of all stocks that are listed on in US stock exchanges, and they use CompuStat. This is all this common practice. Yeah, CompuStat, CRISP data, CompuStat, because of the accounting data. So the accounting data is basically you have access through by using CompuStat. Yeah, this is common practice. Many papers are using the same database. Then also, what we already discussed, they use value-weighted returns, but they also compound equal-weighted returns for each of this trading strategy. Yeah? In order to compare these payoffs. Let's take this away. As we already discussed, in this course we pay more, or this lecture series we pay more attention, or most attention to the methods. So you should learn some methods that you might also use in your own research, related to your master thesis, for instance, or later on. And the method that I would like to discuss with you here is cross-sectional regressions. Yeah? Because this is what they use also in their paper for all of these anomalies. They, on the one hand, compound the sample average, value-weighted, equal-weighted, and on the other hand, they make use of so-called Farmer-Macbeth regressions or cross-sectional regressions. Yeah? So, cross-sectional regressions So, why are those important? Or what does it make sense to use those type of methodology? Well, they argue in their paper that it mitigates the impact of outliers. Yeah? It mitigates or diminishes the impact of outliers. And the other reason is, or one issue that they address in their paper, because they use univariate cross-sectional regressions, and the issue that they address is the multicollinearity problem. The multicollinearity problem. Because if you have more than only one regressor, or when you do multivariate cross-sectional regressions, it could be that a certain characteristic seems to be significant, but the only reason why it turns out to be significant is it is positively correlated with some other characteristics that you use in the regressor set. So that's the problem, and this is what they address with using univariate cross-sectional regressions. So, and this cross-sectional regressions is a methodology that is used in many different papers, and you might encounter it many times when you read the top-notch journals, yeah? And that's why I think it's important that we also go through this methodology, how to implement this. So let's take this away because we need some space here. So first of all, let's just briefly go through momentum, the momentum anomaly, how does this work out? Okay, so let's say again we have here the timeline, and this is today. This is t is equal to 0. And what we do in momentum, or the standard momentum strategy, is basically, okay, we cumulate the returns in the previous months, let's say from months t minus 12 until months t minus 2. Yeah? We compound the sum of returns, the cumulative returns in this period. And then we buy the winner stocks, the winners, and we finance our position by shorting the loser stocks. Yeah? The losers. Yeah? So for all stocks in our stock universe, yeah, we compound the cumulative return in this period here. So, and we determine who has the highest cumulative returns and which of these stocks have the lowest cumulative returns. So we sell those stocks that have the lowest cumulative returns in this period here, and we use this money and buy those stocks that have the highest cumulative return in that period. So as we already spoke, they use these sides. So here are 10% of the stocks, the stock universe, and here are also 10% of the stock universe.